Coming to you live from the mountains of Virginia, USA. I'm just joking. All right, yeah, sorry, I'm just bored in my cabin. It's Friday night. And so I thought I'd put this little slide together on the most important fundamental, why liquidity rules markets and how to read it. This is important, very, very important stuff. So I want to share this with you guys because liquidity is the most important fundamental. That title is not an overstatement by any means. It's the most important driver of moves in the market in every single asset class that you can think of. And ironically, it's also the least understood and least taught about. The mainstream investor classes definitely do not know exactly what liquidity is, but I'm gonna show you guys what it is today. So you are gonna be ahead of the game. So let's just jump in, and I've broken this thing up. It's about a little over an hour altogether, but we're splitting this up into sections just to make it a little more consumable for you guys. If you guys got any questions about anything, just shoot me an email. This is Alex, by the way. Just shoot me an email at alex@macro-ops.com, and I will be happy to get back to you. So let's begin. All right. William Shakespeare, one of my favorites. I just love this quote, and it's kind of applicable, so let's do it. There is a tide in the affairs of men, which taken at the flood leads on to fortune. Omitted, all the voyage of their life is bound in shallows and in miseries. On such a full sea are we now afloat, and we must take the current when it serves, or lose our ventures. That's good stuff, right? I know. Shakespeare was a smart man. And if you read his stuff, actually, there's a lot of parallels over the market. But some people might say I'm a little crazy because I find parallels to market and trading and kind of everything. But maybe that's just a sign of where my mind is. Sorry, let's go. All right, so in this entire course, I'm going to show you how to identify when a sell-off is coming. You know, just like when is a retrace coming? Everybody's, always long and they're always scared, right? Because they're like, oh, when is the market going to have a 5% pullback? Even though we don't see those anymore. Maybe we'll have a 1% pullback. At least that's the way it seems, right, over the last 2 years. But eventually, the volatility is going to return, and when it does, it will return with a vengeance because there's a lot of dry fodder laying on the ground, just waiting to be incinerated. But anyway, so I'm going to show you how to spot a market sell-off coming, which is invaluable. I'm going to show you how to tell where you are in the dead business cycle. Which is, the bull markets, bear markets, they follow the business cycle, right? So it's very important to know where you are in the business cycle. That helps you with your timing. How long do you expect to be in a trade? Well, if you're going to get in a trade, let's say now we're in the latter part of a bull market in the business cycle. Well, maybe instead of a 5-6 year time frame, you're going to have a 1 to 2 to maybe 3 year time frame. And then I'm going to show you how to track true investor sentiment. Because we're all about playing the player, being contrarians and then anti-contrarians, as George Soros would say, when the time calls. And all of this is going to allow you to sidestep or even profit off of large market sell-offs, going short or buying hedges to hedge out your longs. It's going to allow you to better understand where the risk and opportunities lie in global markets. And it's just an invaluable tool for your analytical framework, giving you a much deeper understanding of markets than the majority of players out there. Okay, so I hope you guys are excited about this stuff as I am, and hopefully you get a lot out of it. All right, liquidity, the ultimate fundamental. This is Stanley Druckenmiller. He is a idol of mine, arguably one of the greatest traders to ever live. He's still alive. And he was partnered up with Soros over at the Quantum Fund for a long time. And then he ran the Duquesne funds. But he averaged out a little over about 30% compounding returns over 30 years. And it's just ridiculous how good he was because over 30 plus years, he had only five 5 quarters, not years, but 5 quarters where he lost money. And it was only just a little bit of money. So he literally had 5 down quarters and not a single down year in all 30 years of trading. That is freaking mind-boggling, all right? So, I mean, he's good. And I've spent a lot of time studying him and Soros and, all the greats, because they've obviously they're doing something right? So, anyways, this is one of the most important things that he's ever said, and which ties into what we're going to be learning about today. So he says, earnings don't move the overall market. It's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. Most people in the market are looking for earnings and conventional measures. It's liquidity that moves markets. Just what I was saying, right? So he's just confirming what I'm saying. Okay, very few people actually understand liquidity, which is why it's so valuable. That is absolutely true. And like Drake said, most market participants don't really know what moves the market. They're focusing on things like valuations, earnings, GDP growth, chart patterns, analyst revisions, sunspots. I don't know. They're focused on a bunch of nonsense, right? Like PE. How much time have you spent paying attention to PE ratios? Oh, I can tell you. I mean, from my own experience, I've been in this game for a while now. PE ratios will lose. Focusing on stupid, dumb metrics like PE ratios will lose you more money than they'll ever make you money. That is absolutely fact. I mean, look at all the great companies today. I mean, you got like Amazon, Facebook. I mean, if you would have been like, oh, I can't buy them, like 10 years ago, I can't buy Amazon. It's trading at it doesn't even have earnings, right? Or Facebook is trading at a 40, 50 PE. It's way too expensive for me, when it was only, like trading at a few $1 billion market cap. I mean, so that's insane. If you're paying attention to this stuff, because these are just dumbed down numbers, they're metrics without context. And so things like, of course, I'm not saying valuations don't matter, earnings don't matter. Of course they do. They matter. But what you need to know is what is really driving the stock. I mean, the whole point of this game is to make money, right? So you're gonna buy low and then hopefully sell higher, or sell high and buy it back lower, right? But you need to understand what is really driving that, okay? And so, yeah, sure, valuations, earnings, they matter a little bit, and it depends on in what context. But behind each and every single one of those, behind like a Facebook that's trading at a 40 that can go up a lot further, well, is liquidity, all right? Liquidity is the most fundamental of the fundamentals. It is a first principle. It's the number one thing. It affects valuations. It affects earnings. It affects GDP growth. It drives price action. So that is why you need to know it. Moving on. All right. And so my hope is once I teach you guys all about liquidity, once we're done with the next few sections, you guys are going to know how to stay on the right side of markets, right? Because, if you're watching this, you're on, FinTwit or something like that, and you see all these perma bears constantly fighting the market, battling the market, being like, oh, the market's wrong. It's overvalued. It's going to crash. And they've been saying that for the last 3 fucking years, right? Why the hell would you want to do that? Why do you want to fight the market? Why would you ever try fighting the market? It's stupid. You're an ideologue, So an ideologue is just another word for dumb, right? Because you're so bought into this concept of how the world should be, yet the world is nothing like your preconceived notions. And so all you do is lose money. That's the whole point of this game. Is not about sticking to an ideology and battling it out, or proving how smart you are, or even being proven right. It's about making money. And the best way to make money is by understanding liquidity. All right, so you don't have to. You never should be battling the market. You should always be trying to ride the wave. And behind the wave is liquidity. Okay, so the people that you see doing that, they're either trying to sell a newsletter because the sad fact is that you sound a lot smarter when you're bearish. You sound responsible or some bullshit, and they don't understand how the world really functions, how markets really work. They definitely don't understand liquidity, but you guys will. Okay, so this is I'm trying to keep each of these sections short. So this is just an intro, right? This was a conclusion, just kind of a jumping off point of what we're going to be covering over the next couple of sections. So I'm just trying to help you guys out. I want you guys to understand how important this is. Like most people, we were all brought up. We all learned about markets through the conventional route. Like I said, PE multiples, earning, and stuff like that. We studied Ben Graham, Warren Buffett, or a bunch of price action technical analysis. All that stuff is good. That's good. But behind all of that is an underwriting principle that affects each of those variables. What a lot of people don't understand is that, like, for 90% plus of plays you're going to do, especially in stocks, let's say you're going to go long airliners, right? You're going to buy United Airlines or something, or Southwest, whatever. Well, you can dig into that company, understand their fundamentals, their valuation metrics, all you want, right? But what most people don't understand is that you're making an embedded macro call when you buy those airliners, because 50% of the move in that price action of that single stock, of that airliner stock that you buy, is going to be due to macro reasons. Then 30% is going to be due to sector-specific reasons to the airliners. And then maybe 20% is going to be alone to that single specific stock. So everybody has it backwards. They're spending all their time trying to understand, the balance sheet and the next quarter's earnings for this, Southwest or whatever. But they don't understand what's moving the broader market and what's moving the sector. I can tell you right now, it's like the broader market, the macro is liquidity, which that's what we're going to cover today. The sector, if you know anything about airliners, you're basically making a call on oil prices, because fuel prices are their largest cost, right? So it's an embedded macro call. So you got to understand where the price of oil is going to go, because that's tied to jet fuel. Well, if you want to understand where the price of oil is going to go, then you need to understand where the dollar is going to go, because oil is priced in dollars. It seems complicated, and that's going to be. I'm going to cover that stuff in another talk some other day. But going back, if you get liquidity, well, you already got at least 50% of the puzzle, if not more. And that's what we're going to be covering in the next couple sections. So perk up, pay attention, and let's dive into this. I will be back here when you guys open up the next section, I guess. All right.